Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for another edition of That's Our Two Satoshis Live. For anyone watching for the first time, every week we write a blog on our website at ar.ca/blog where we talk about things that are going on in the digital assets market. And this past week, we talked about a few different things, and you can reference the blog yourself or you can listen to me here for a few minutes. But basically, what everybody wants to know is what's going to happen to this market. And of course, we don't know the answer to that. We have no idea if we're going up or down, but we're starting to identify a few green shoots. And green shoots meaning, just like it sounds, some things that are kind of sprouting out of the market that give us a little bit of hope that spring is along the way. We're 100% still focused on macro, just like everyone else. There's a big CPI report coming out later this week, which begs the question why all the markets are still being impacted just by 12 unelected Fed officials who are pretty much openly at this point trying to create job losses and stem inflation. But we'll be watching macro. But there's more than just macro that we need to be looking for right now. In fact, I identified in the blog 3 different things that we're looking at right now to let us know if, in fact, the waters are a little bit clearer and it's time to jump back into digital assets. So the first, macro. There's 2 things that the central banks care about. They care about inflation and they care about jobs. Last week, we saw a very strong jobs report. Normally, that'd be something to celebrate. Your friends, your family, everyone is working. That's great. In an inflation world, jobs are bad, right? Jobs mean you're going to have wage growth. Jobs mean we need to stem the demand side a little bit to kill jobs and to kill inflation. So when we see the CPI report next week, if you see any signs of weakness at all, that will give investors a little bit of confidence to put money back to work across all asset classes, equities included. The problem is the CPI report is delayed, right? This is 4 weeks old data. Since the data came out for the CPI report, which we're going to see later this week, we're seeing a lot of leading indicators rolling over. We're seeing commodity prices, car prices, home prices, everything's starting to go down. So I think we're heading towards peak inflation, but we're not there yet, and we probably should brace ourselves for a pretty big number, which most likely will give investors pause at least for a couple of days. But the other 2 things we're looking for are, when does the forced selling end? Right? We've all seen thousands of headlines now about 3 arrows borrowing from every counterparty and their collateral being liquidated, as well as some of these DeFi vaults on Maker and Aave that companies like Celsius are continuing to unwind. So we're looking for, when does that forced selling end? It's impossible to know for sure. And obviously, if the market goes lower, it might set off a new wave of forced selling. But all of our channel checks for right now make it seem like, for the most part, the collateral that was owned by lenders has already been sold. And it doesn't seem like there's a lot of more forced selling at these levels. And lastly, what we're looking for is fundamental improvement. And by fundamental improvement, we're looking at, for those non-Bitcoin and cryptocurrency digital assets, right? The ones in DeFi and Web3 and gaming and NFTs, ones that actually have real revenues and cash flows. We're looking for that fundamental improvement, right? Will we see an uptick in transactions? Will we see an uptick in volumes? Will we actually see revenues accrue to these protocols in the form of fees and ultimately get dividended or bought back via the token? We haven't seen a lot of that yet. And I think that's probably the most difficult thing for digital asset investors right now, is that even though there are business lines that have nothing to do with each other, while this is still a small growing industry, it is all still very highly correlated to, are there users actually making transactions on DEXs, and are they actually playing games and doing everything, right? So it all comes down to user growth. It all comes down to transaction growth. When we see that, you look for these tokens that have high operating leverage. And what we mean by operating leverage is, for 1 unit of whatever you're measuring, right? For 1 unit of a new user or 1 unit of a new transaction, which are the companies and projects that will have amplified growth in terms of metrics and ultimately their token price per that 1 unit additional. So we're looking for those companies and projects that have high operating leverage, that when we see these fundamentals improve, you'll see significant gains in the token price. But in the meantime, the one encouraging sign that we are seeing today is that companies and projects are starting to put out news again. This is an industry that doesn't have what's called Regulation FD, which is full disclosure, right? The equity and debt markets, the public companies in the U.S., they are required to report every 3 months with their 10Qs, and they're required to report with 8Ks when there's material information. They're required to put any new information out there all at once to investors. The digital asset space, as an unregulated entity right now, doesn't have those rules. And as such, companies and projects and founders are free to release information whenever they want. Most of them have been trained not to release information during a bad market, because why would you? You're not going to get rewarded for it. But they will release information during a good market because they want to be rewarded with higher token prices and volume and interest. Well, even though obviously this is not a great market right now, we're starting to see companies and projects start to release news again. And more importantly, they are being rewarded for it. So in the last few weeks, we've seen everything from DYDX to Binance to MakerDAO to FTX to Axie Infinity and Solana. Last week, we saw news coming out of Flow. We saw a couple positive reports coming out about partnerships with Polygon. You saw some information with Ethereum regarding the ETH 2.0 merge. You're starting to see, and of course, Aave as well, introducing their new collateral-backed stablecoin. So when you start to see projects release news, and just as importantly, you see the market reward them. All those companies and projects I just mentioned had their token prices move in double-digit ranges and certainly outperforming the rest of the market. That's a good sign, right? That tells you that there is interest on the sideline. There is interest in buying some of these projects when and if they see a reason to buy. And when you get positive news, they're buying. So in general, I'd say, if you're looking for green shoots, that's probably the biggest one we've seen in the last few weeks. And I'm guessing more and more companies and projects will follow suit now that they know that the market is willing to reward them for this information. Secondly, the other thing we mentioned on the blog this week was written by my partner, Sasha Fleischman. You can follow him at Arca Chemist. He's not able to join today, but we talked about OpenSea and what they're doing with regarding to freezing some assets or blacklisting some assets. So if you're not familiar, again, Sasha put out a great Twitter thread, or you can reference it on our blog, talking about what's happening here. So essentially, OpenSea is a company, right? They have a board of directors, they have a CEO, they have shareholders, right? They have to do what is in the best footing of their shareholders. And they, for legal and regulatory reasons, have decided that if there's any sort of a theft of an NFT, if there's any stolen NFTs or phishing attempts, anything that transfers the NFT without it being purchased, that OpenSea is going to blacklist that. It basically means that it will not be able to be resold on their site. The problem is it's very loose rules with regard to how do you report an NFT was stolen. So what's happening here is OpenSea, in their eyes, is doing what they think is right, but in the market's eyes, you're not really punishing the right people. So here's an example, right? I own an NFT. I get that NFT stolen by counterparty X. Counterparty X then immediately sells it to, John Smith on OpenSea. And then after the fact, someone reports it that was stolen, and OpenSea blacklists that NFT. Well, the only people who got hurt here was me, who got my NFT stolen. It doesn't help me at all. And it hurts the new buyer, who didn't even know it was stolen when they bought it, and now their asset is frozen and they can't do anything with it. It doesn't at all hurt counterparty X, who actually stole the asset. So whether or not OpenSea is doing this with good intentions, the reality is it is a horrible decision, and it is massively affecting NFT users, because once these NFTs get blacklisted, they start trading on LooksRare or other places with less liquidity, and they usually trade at a 10 or 20 or even 30% discount to fair value because they've been blacklisted on OpenSea. So, we've been calling out to OpenSea, asking them for change. I think others have as well. But this is something that's worth watching, because OpenSea has a commanding lead on the market in terms of the volumes of NFTs, but there are competitors on their heels, right? LooksRare, I mentioned, is number two. And certainly you have other companies like Coinbase who have attempted to get involved in the NFT market as well. But look, we know what happens when an incumbent gets too complacent and others eventually usurp them. I mean, look at Coinbase, right? Just getting surpassed by FTX the other day in volume. Coinbase had a huge lead, and now FTX is bigger and more powerful than them. OpenSea's got people nipping and companies nipping at their heels as well. I'd imagine they're going to have to address this pretty soon, because it's certainly not good for the NFT market. It's definitely not good for NFT users. And it's, in our opinion, seems like a pretty big mistake by OpenSea to do this. So you can read more about it on our blog. I'd encourage you reaching out to Sasha at Arca Chemist if you want more information there as well. And then finally, just quickly, this is worth actually going to the blog itself. Again, it's you get the blog at ar.ca/blog, or you can find it on our Twitter account. But we talked about the taxonomy of digital assets, right? We've been big believers that everybody just calling this market cryptocurrencies is a misnomer, right? It's very misleading. There's very few cryptocurrencies, Bitcoin being one of them. Most of the other digital assets have completely different properties, right? You have different issuer types, from governments to individuals to DAOs to companies. You have different token types, from currencies to asset-backed tokens to pass-through tokens. You have different sectors, et cetera. We were one of the first to put out a taxonomy to really map this out, this ecosystem. Well, shout out to another Twitter user who I don't know, but he goes by the name of David Phelps, and you can find him at divine_economy. But he put out a Twitter thread a few weeks ago talking about what he thought was the right taxonomy and how many different types of digital assets there are. Everything from digital art to data records to game pieces, passports, social graph, messages, and governance. It was pretty interesting. I'm not going to go into too much detail today. You can go reference our blog and look at it. But while I didn't agree with everything that he put in there, I want to give him a special shout out and applaud him for thinking this through, because I think the more investors in this space start to really classify what digital assets are and how they're unique and different, the faster we get away from this horrible and incorrect narrative of everything being the same and everything trading together and everything just being a cryptocurrency. There's clearly different tokens. There's clearly different use cases. And the more people like David Phelps who put this together, or like Arca who puts together a taxonomy, the faster we get people to really understand this industry and why it's valuable. So shout out to David Phelps. Again, I encourage you to follow him. I encourage you to check out our blog, and we'll see you again next week. Thanks for joining, everybody.